Hi, my name is Jake Bernberg. I'm known as the deduction detective, and that's because I've investigated the tax code and found lots of uncommon deductions that most people don't know about that we are able to use with our clients to help them stop wasting money on taxes that they legally don't have to pay because of these loopholes in the tax code. I'm an IRS enrolled agent. That means I'm licensed by the IRS to prepare taxes and represent people in all 50 states, and I specialize in strategic tax planning. Today, I'm just going to go over the basics of how taxes work and give you one thing to take away that is going to be very valuable for you in terms of paying less in taxes. So let's just start out by taking a quick look at how the system works. This will lay a foundation for understanding the specific strategies we talk about in other videos that will be published soon. The process starts with income, and this includes most of what you'd think the IRS is interested in: earned income from wages, salaries, bonuses, and commissions, profits and losses from your own businesses, interest and dividends from bank accounts, stocks, bonds, mutual funds, capital gains from property sales, pensions, IRAs, and annuity income, alimony and gambling winnings. Even illegal income is taxable. The IRS doesn't care how you make it, they just want their share. The good news is, if you're operating an illegal business, you can still deduct the same expenses as if you were running a legitimate business. If you're a bookie, you can deduct the cost of your cell phone you use to take bets. Once you've added up total income, it's time to start subtracting adjustments to income. These are a group of special deductions listed on the first page of Form 1040 that you can take whether you itemize deductions or not. Total income minus adjustments to income equals adjusted gross income, or AGI. Adjustments to income are also called above-the-line deductions because they take them above AGI. Adjustments include IRA contributions, moving expenses, half of your self-employment tax, self-employed health insurance, self-employed retirement plan contributions, alimony you pay, and student loan interest. Once you've determined your adjusted gross income, you can take a standard deduction or itemized deductions, whichever is greater. The standard deduction for 2016 is $6,300 for single taxpayers, $9,300 for heads of households, $12,600 for joint filers, and $6,300 each for married couples filing separately. Tax deductions reduce your taxable income. If you're in the 15% bracket, an extra dollar of deductions cuts your tax by 15 cents. If you're in the 35% bracket, that same extra dollar of deductions cuts your tax by 35 cents. In 2016, you can also deduct a personal exemption of $4,050 for yourself, your spouse, and any dependents that you may have. Once you've subtracted deductions and personal exemptions, you'll have taxable income. At that point, the table of tax brackets tells you how much to pay. You may also owe self-employment tax, which replaces Social Security and Medicare for sole proprietors, partnerships, and LLCs. You'll also owe state and local income tax on earnings that you make. Some types of income aren't taxed at the regular rate. For example, tax on qualified corporate dividends and long-term capital gains is capped at 20%. There's also a 3.8% unearned income Medicare contribution on investment income for single taxpayers earning more than $200,000 and joint filers earning more than $250,000. For purposes of this rule, Investment income includes interest, dividends, capital gains, rental income, royalties, and annuity distributions. Oh, and don't forget that your itemized deductions and personal exemptions start phasing out once your income hits certain levels. For 2016, those are $259,400 for singles and $310,300 for joint filers. Bottom line here is that tax brackets aren't as simple as they might appear. Your actual tax rate can be quite a bit higher than your supposed tax bracket. Finally, you'll subtract any tax credits. These are dollar-for-dollar tax reductions regardless of your tax bracket. So if you're in the 15% bracket, $1's worth of tax credits cuts your tax by full dollar. If you're in the 35% tax bracket, an extra $1's worth of tax credits cuts your tax by the same amount. There's no secret to tax credits other than knowing what's out there. Finally, there's two kinds of dollars, just like there's two kinds of people. Two kinds of people is kind of a joke. There's two kinds of people, people who believe there's two kinds of people and people who don't. Two kinds of dollars, there's pre-tax dollars and there's after-tax dollars. Pre-tax dollars are much bigger than after-tax dollars. And so every time you have an opportunity to spend a pre-tax dollar instead of an after-tax dollar, you're much better off. In fact, the takeaway that I want you to leave with today is this. You lose every time you spend after-tax dollars that could have been pre-tax dollars. It's something you might want to read over and say again to yourself. You lose every time you spend after-tax dollars that could have been pre-tax dollars. In future videos, we'll talk about how you can spend money that you're already spending after-tax dollars on, and I'll show you how you can use pre-tax dollars for those expenses. I hope you enjoyed the information on this video. I'm happy to talk to you about the specifics of your situation. There's no charge for an initial 30-minute tax analysis to see how many of your tax dollars we might recover. Thank you, and talk to you soon.